Okay, back at it. Sorry for the Twilight Zone graphics, but this is how I have to start the lecture. All right, so talking about the different types of taxes. Implicit taxes, these are indirect taxes that result from a tax advantage that the government gives you, the taxpayer, to encourage you to enter into certain types of transactions. And so these are reduced before tax return amounts that the tax favored asset produces because of its tax advantage status. Now, because they're difficult to quantify, that's why they're implicit rather than like an income tax, which is explicit. In other words, you can figure out exactly how much taxes you have to pay. You simply determine your tax base and multiply it by the tax rate. And so, but you can still figure it out. I mean, um, there's no, I guess the point here is it's implicit in that the government doesn't say, well, you're going to pay less for this. Um, they just don't tax it. So, and the reason why it's less, usually there's a return that's less than what you could get from a taxable investment, is because you're not taxed. And so rather than going around in circles on this and trying to explain it, it's best to give you an example. Income that you earn from your job is taxable income. Why? Because Congress said it's taxable. That's why. Now, again, Congress has encouraged taxpayers to do certain things, enter into certain types of transactions. And so, in order to encourage them, they create certain tax benefits for these investments so that it will encourage you to buy them. Okay? Well, what kind of things are those? What type of investments are those? Well, the perfect example is um, bonds issued by state and local governments. Bonds that are issued by state and local governments pay interest on those bonds to the individuals or companies who buy those bonds, invest in those bonds. And so the interest that these bondholders receive are non-taxable to the bondholders. And so the implicit taxes come in the fact that because the entity that issues the bond knows that there's no taxes that are going to be due and payable by the people and companies that buy these bonds, they're able to charge a lower interest rate on those bonds than, say, a comparable bond issued by a corporation. Bonds issued by a corporation are taxable. Any interest that's paid to the bondholders on a corporate tax is taxable to the bondholder. And so the difference between the amount of interest that's paid by the state government entity on their bonds is going to be lower than that of a corporate entity that issues their bonds. And you'll see an instance, and there's some examples. You look at Chapter 1. Example 1-12 on page 16. Coca-Cola bond versus State of Georgia bond. Note if the before tax return is the same, the after tax return, here you have a Coca-Cola bond which is taxable. The State of Georgia bond's not going to be taxable. If the before tax returns are the same on those two, then the state bond is going to have a greater after tax return because there's no tax on the state bond than the Coca-Cola bond, which is taxable, and thus because it's taxable, they're going to have a smaller after tax return. And so usually you're not going to have a situation where the before tax amounts are the same. Usually they're going to be very different. You're going to have a higher before tax return on the corporate bond than you're going to have on the municipal bond, state, local, county, because the municipal entity can afford to do that. And so how does the corporate bond stay competitive with the municipal bond? Well, you have to figure out what the after-tax return difference is, if any. And so, you might want to try, if you're a corporation issuing a bond and you want to compete against these municipal bonds, you might try to figure out what you need to do, where you have to be in your after-tax return to be competitive with the municipal bonds. All right, enough said on that. How do we evaluate different tax systems? We talk about, well, do we have the right tax system? Does it need to change in any way? Well, you can look at this from several standpoints. First of those is our tax system sufficient? Meaning, does it give us enough revenues so that we can do whatever it is we need to do in this country, or state, or county, or local government? Equity. Is the tax burden distributed properly? Is it fair? Is the tax system we have now certain? Meaning, do we know when to pay the taxes, where to pay the taxes, and how much? Yes and no. Is our tax system convenient? For the most part, it is, because if you're your typical worker, the money's taken out for the most part of your paycheck. Is our tax system economic? Meaning, are costs to the taxpayer held to a minimum? When you think of sufficiency, again, this is not from a uh, taxpayer standpoint. This is from a uh, taxing entity standpoint, trying to figure out if they have enough tax revenue to do whatever it is they need to do. And when they do this, they have to do some planning when they're, let's say, um, planning a new tax. Okay, if we pass this tax, how much revenue is it going to get us? Well, there's a couple of different ways to forecast that revenue. You could do it using static forecasting. This ignores what taxpayers might do to alter their activities in response to the tax law change. And it bases projected tax revenues on the existing state of transactions. A perfect example of this would be the city of Seattle. Uh, I think they've done a couple of things. They've done like a soda tax, and they've done, I don't know too much about that, but the one I do know about is um, they initiated a tax on gun purchases. And so they just, estimated, well, here's how much gun sales we've had. If we propose this, if we pass this tax, we're going to have this much sales, and multiply that times the rate. This is how much additional tax we're going to have. Well, the problem is they ignored human behavior. Well, what happened? Well, actually, tax revenues fell because gun sales, well, they fell way below, not beyond, but they fell well below um, what was projected as far as tax revenues. Well, why is that? Well, because human nature. Um, Instead of purchasing the guns in the city limits, they went outside of the city limits. Easy as that. Well, so City of Seattle apparently used static forecasting in determining how much revenues they were going to have from gun sales. The better way should have been using dynamic forecasting, which tries to predict possible responses by taxpayers to these new taxes. A couple of things to consider is the income effect, meaning as the tax rates go up, people will work harder to maintain the same after-tax income. That's good for the taxing entity. It's also good for the worker. There's some people that are going to have that kind of motivation. Okay, I'm making the same amount, and you're going to tax it at a higher rate. Well, okay, I'm just going to work harder to make the same amount. On an after-tax basis, meaning. There's also the substitution effect. As tax rates go up, Some people will substitute non-taxable activities for the taxable activities because the marginal value of taxable uh, activities has decreased. All right, equity. And back to substitution effect. For that, look at example 1-14 and 1-15 on page 19 of chapter 1. Is what we're doing equitable? Is our tax system equitable? Well, there's two types of equity. Horizontal equity means that two taxpayers in a similar situation, meaning they have the same amount of income, pay the same tax. And then we have vertical equity, meaning taxpayers with greater ability to pay tax pay more tax relative to taxpayers with less ability to pay tax. I think probably most people would say we do have vertical equity as far as our current system is concerned. Not sure you could say we have horizontal equity because let's say two taxpayers both make $50,000 a year, but one, again, back to what I talked about earlier, uh, one of the taxpayers owns a home, the other rents. The taxpayer who owns the home is going to get mortgage interest deduction as well as deduction for property taxes paid. So they're going to pay less in taxes than the person who rents, even though they both make the same amount of income. So in certain situations, our current system, from a horizontal equity standpoint, is not equitable. A couple of things, even though it says end of uh, presentation, not sure why it does, because there's still a couple of things left. Certainty, again, means that the taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to determine the tax. Usually, when to pay the tax is pretty easy. Taxpayers are supposed to pay all their taxes and file a tax return uh, by April 15 of the year following the tax year at issue. And so for tax year 2018, you've got to have your tax return sent in, prepared and sent in by April 15 of 2019. For business entities, it's a different due date. You're also supposed to pay in full by April 15 of the following year. As far as where to pay the tax, usually they just tell you. Um, Most people either use a tax service or they get online and use tax software. And so they tell you where to send the return and payment. So that's usually pretty easy. How to determine the taxes, that's a little more complicated. And I would have to say our system of taxation, especially at the federal level, is not very good because taxpayers spend a lot of money on tax specialists. Tax specialists make a lot of money off of taxpayers. Is our current tax system convenient? Well, for the most part it is, in that if you're a working schlub like me, all my taxes for the most part are taken out of my paycheck, and we're what we call a pay-as-you-go system since 1943. And so your employer is required to withhold income taxes and pay it over to the government. So from that standpoint, pretty convenient. Is our current system economic? Meaning it minimizes the compliance and administration costs associated with the tax system. Not at all. Like I just said, taxpayers pay a lot of money to tax specialists to prepare their tax returns. So it's not very economic. It's not very cheap. We pay billions of dollars to get this stuff done. All right, so that's the end of chapter 1. Hopefully my mouth will work and my brain will work better in the future.